Hello, thank you for joining us. My name is Mark Torgerson, and I'm the Sales and Marketing Team Lead here at Implementation Specialists. Today we're featuring a special guest, Brenner Klensman, President of WilloWare. WilloWare is a company dedicated to helping businesses achieve a positive return on investment using Dynamics GP. And they do this by providing unique products that help users be more efficient and by partnering with you to create client-specific enhancements that streamline business activities like tariff management. So just a few housekeeping items. We will take questions at the end of the presentation. So feel free to type in your questions at any time. And we will send out a link to a recording of this presentation as well. So with that, I'd like to turn it over to you, Brennan.
Well, thank you. All right, so we are going to start by taking a quick run through of the landed cost functionality. If you've looked around on the internet regarding Dynamics GP and tariffs, you have probably come across the use of landed cost. So there are a few potential issues with landed cost. First of all, if your inventory is standard cost, the additional cost of the tariff would go to purchase price variance. And so the end goal of completely loading the cost of the inventory with tariff doesn't happen. If your inventory is the actual cost, but you've already used the inventory, the same thing happens. The tariff goes to purchase price variance and the inventory stays at its original cost. The best case scenario when everything does work is that the inventory does get revalued. But as we've seen with the tariffs, they can go up quite a bit, they can come down quite a bit. This can happen within a short period of time. And if you're building that cost into the cost of your inventory, that makes your inventory value fluctuate wildly. Then COGS will fluctuate, your margins will fluctuate, and they're difficult to analyze. If you use GP manufacturing and you use the material in manufacturing, then the manufacturing costs fluctuate. It makes it difficult to report on manufacturing efficiency. So there's several issues with including the tariff cost into the cost of the inventory. So another way to go about doing this is on the purchasing side, there's a couple of different ways that you could record the tariff cost that makes it hit an accrued tariff expense account. So one option would be that you have a non-inventory item and you can put that onto the PO invoice and record the tariff surcharge that's coming from your supplier. And then on that item, you'd have the inventory account set up to be the accrued tariff expense account. Another option would be to use the miscellaneous field. And again, you can do posting account setup for the purchasing account so that the miscellaneous points to a accrued tariff expense. So once you've accomplished that, you've got the tariff cost going into a tariff expense account. The other side of the equation is how to figure out how to pass that through onto sales and recover that expense. And that's where our module comes into play. And we're going to look at a demo in just a second. But the flow of this then is when you create the sales order, our tariff module will calculate what the tariff load should be on those items. And then it has several different methods for adding that into the sales transaction. The way that it puts it onto the sales transaction, that pass-through tariff then hits an applied tariff revenue account so that this eventually ends up at the general ledger. Okay, so let's jump into GP. And I'm going to start at the end of the process. We'll just look first at how the tariff gets added onto the sales transaction, and then we'll circle back and look at some of the setup and options for the module. We're doing it here on an invoice. You could do it on an order. If you do it on an order, it works kind of like taxes. It takes a snapshot of the tariff calculations used on a per line basis, and those stick with the order. So if you calculate tariff on an order today, but you don't invoice it for 2 weeks, and in the meantime, the tariffs have changed, it sticks with the tariff calculation that was performed when the order was entered. So you take your document and you recalculate the tariff. And you can see in this case, the module is set up to add in the tariff on a per line basis. So this is a calculation for 100 XLG, and this is the calculation for 128 ST-RAM. If you're familiar with the sample database, 100 XLG is a made item. It has a manufacturing bill of materials. And when it's doing this calculation, it's blowing through the manufacturing bill of materials. And so it goes through the entire exploded bill of materials and it looks for everything in here to see if it has tariff. It calculates the tariff that applies to that item and it rolls everything up. And that's how it comes up with the tariff for the sales line. And in this case, this is a resale item. And so it's just calculating the tariff directly on this. So there's a few different ways that it can put the tariff onto the sales transaction. Right now it's set up to do it per sales line item. And I'll change this and we'll do it as a line total. Now you can see it adds them together and puts it on as a single line. And now we'll take that off of here and come back over here and change it back to the third method, which is to use the miscellaneous charge field on the sales transaction. And then you can see it sticks it down here in the miscellaneous charge. Okay, so now we'll take this guy back off here. We're going to go back to the line calculation. Okay, and so then the distributions are coming from the line items. And it doesn't make any difference how you have sales set up. It can be pulling the distributions either from the customer or from the item. Regardless, the way that we're adding this into the transaction, you'll get a separate distribution just for the tariff. So in this case, it's hitting a applied tariff revenue account. Okay, so let's jump back over into the setup over here. As I mentioned, it can use the manufacturing bill of materials. It can also use the inventory assembly BOM, and it can also use kits. So in all of those cases, it does essentially the same type of calculation where it takes the top level item, it looks up the bill of materials or the kit, goes through all of those components and calculates the tariff, rolls that up to the top. The high level way that the tariff is calculated is based on a combination of a item country of origin association and a country level tariff. So at the at the item setup level, I'm just finding my spreadsheet here. So all of the setup windows, we did something a little bit unique with this, and I'll take these out of here. We assumed that there's going to be a lot of data involved with this. So you don't have to look up everything line by line. You can prepare it in a spreadsheet, copy from the spreadsheet, and paste into the windows. So that works in the item country. It also works in the country tariff. We'll pull those out of there. So it makes it really quick to get up and running with the software. There's several different methods for calculating the tariff. Percent value, this is a percentage of the cost. So it's either the current cost or standard cost. You can do a specific dollar amount per unit, dollar amount per weight, and a percent of extended price. One reason that you might use percent of extended price is it obscures your margins a little bit more. You can change what the percentage is to account for the markup. You still end up with the same tariff calculation, but if it's coming calculated as percent of value, it's a little bit easier for someone to work backwards from that calculation to figure out what your cost is. You can also specify an item level tariff. The same options are available here, but the one that is used most frequently is the additive method. So this works in conjunction with the country level tariff. So you might have a country level tariff of 50% plus $25 per item on this specific item. And what this is doing in this case is this might be a additional duty based on the material content of the item, such as aluminum or steel. Tariffs can also be calculated at the item level. The most common thing to do with the item, with a customer tariff setup is to exclude specific customers. You might have perhaps a contract with a customer that says that you can't add a tariff surcharge, for example. All right, guys, that's it. I'm going to pop back to our last slide if I can figure out how to bring this up again. And now we can open up for questions.
Yeah, Brenner, maybe if you could just recap real quick, because we did have a few people join late.
Sure.
So maybe just recap what you did real quick, and then we will be sending a link out to the presentation. So, and then we'll open for questions.
Yeah, not a problem. Okay, so let's actually, we can just run through the whole thing really quick.
Okay. Okay.
So, sorry, I'm going to show you this thing because I have trouble flipping this thing back and forth. So we looked at use of the landed cost module. And one of the challenges with the landed cost module is that it doesn't always do what you want it to do. And ideally what you want it to do is add the cost of the tariff into the inventory item itself. The problem is that doesn't always happen, and it often ends up going to purchase price variance. And then you're not doing a good job of tracking these tariff expenses. Even if it does work, putting that tariff cost into the inventory cost causes it to fluctuate wildly as tariffs change. Our module helps solve this situation by calculating how to add tariff back into a sales order. You can record it on a purchase order so that it hits a accrued tariff expense account. And then our module adds it back into the sales order in a way that it hits an applied tariff revenue account. That makes everything flow through to the general ledger. There's a few different ways of calculating the tariff. A few different ways of applying the tariff. It can either do it on a per line basis. It can do it as a total for the entire document, and it'll add a single line, or it can add it down into the miscellaneous field. One thing that I forgot to mention when we were looking at this before is it's creating the item description based on how it calculated the tariff. So in this case, what it's telling you is that there's a 50% of value tariff coming from China. How this is populated is something that you can define at your site. So this is customizable. It doesn't have to say this. It could say something different. And let's see, what else? The tariff is kind of calculated like a tax. So it stores it at the time that you do the calculation, it would stick with a sales order. And then when you do a transfer of order to invoice, that original calculation stays with the order. It also works with partial transfers too. So if you have a large sales order and do multiple partial transfers to invoice, that original tariff calculation will come along with each invoice. And then we took a quick look at setup. How was that? Pretty
Perfect.
good?
Excellent.
Okay.
So any questions, feel free to type them into the question box. We'll hold on for just a minute here. And sorry if you had audio issues. I think everybody else was hearing it fine, but I know there's at least one attendee that was having an audio issue. All right, doesn't look like we have any questions unless somebody's typing. And I think we do have maybe if you could flip back to the slide deck there, Brenner, we do have a contact slide. So if you have questions, you can reach out to Brenner directly, or feel free to reach out to myself, Mark at Implementation Specialist. So great, no questions. So thank you, Brenner, appreciate it. And thank you everyone for joining us this afternoon.